All right, let's dive into Japan's real estate market. It's been on fire for a while now, but the latest data from October 2025 is showing us something really interesting, a deep crack forming right under the surface. Today, we're going to break down a market that's literally moving in two different directions at the same time, and what that actually means for anyone paying attention.
So, the big question on everyone's mind is the party over? Is the market finally cooling off? Well, the answer isn't a simple yes or no. In fact, it's kind of like a tale of two cities. Depending on whether you're looking at a huge office tower or a single-family home, you're going to get a completely different answer.
And here's the proof, right here in the numbers. It shows you exactly why this is so complex. Just look at the contrast. On one side, you have the office leasing market, where business sentiment is soaring at a positive 26.5. But on the other, the residential brokerage world is feeling pretty down at a negative 9.3. It's night and day. This isn't one market with one trend, it's two different stories playing out at the exact same time.
So that really brings us to the main theme for today. The market is split right down the middle. This isn't just a hunch. The latest real estate survey is showing a clear and growing divide between different kinds of property. So let's peel back the layers and break down each side of this thing.
Okay, first up, let's talk about the good news, the office sector. The feeling here is all about strong confidence and some serious growth. For any investors who are focused on commercial property, this is where things start to get really interesting.
And check out this number, 52.9. That is the rent trend index. Now, just so we're all on the same page, anything above 0 means rents are going up. So a 52.9, that is not just positive, it is incredibly strong. It's a massive signal that landlords are totally in the driver's seat, and they're pushing rents higher pretty aggressively.
And get this isn't some random fluke. This is the 9th straight period that this index has gotten better. 9. That tells you we're seeing some serious sustained momentum. The office rental market isn't just healthy, it's actively getting stronger.
So what's behind this boom? Well, it's a classic positive feedback loop. Businesses are feeling good, so they're expanding. That means they need more office space, and boom, vacancies go down. And when there's less empty space available, you guessed it, landlords get pricing power and can charge more. And maybe the best part is, the forecast for the next 3 months looks just as positive. So this cycle seems like it's here to stay for a bit.
But now, okay, take a deep breath, because we are about to flip the script completely. Let's talk about the housing market, and well, it is a totally different beast. We're looking at a classic standoff between record high prices and the hard reality of what buyers can actually afford.
This chart just says it all, doesn't it? On one hand, you've got the sales price index for new homes, which is way up there at 50, and in fact, prices have gone up for 54 periods in a row. That's just wild. But look at that other bar. The number of contracts actually being signed has completely cratered, with an index of negative 33.9. So prices are in the stratosphere, but actual sales are falling through the floor.
And the reason why is pretty simple. It's summed up perfectly by this one insight from the survey. Buyers just can't keep up with the prices anymore. That's it. We've basically hit an affordability wall. Construction costs are rising, which forces developers to jack up their prices, but people's wages just aren't keeping pace. So the market is stalling out simply because the customers are being priced out.
And this isn't just about new condos. The secondhand market is also grinding to a halt, but for a slightly different, kind of strange reason. So step 1, yes, prices are still rising here too. But look at step 2. The number of people even putting their homes up for sale has fallen off a cliff, down to negative 40. This means there's a serious shortage of properties even available to buy, and that's just choking the life out of the transaction volume.
Okay, so we've got a market with a split personality, right? Offices are hot, housing is not. The million-dollar question for anyone investing or even thinking about it is, what on earth do I do with this information? How do you navigate a market that's running at two different speeds?
For the housing side of things, there's one key term you really need to understand: stagflation risk. It might sound a little academic, but the concept is simple and it's dangerous. It's when prices are high but nobody's buying, so liquidity completely dries up. It means you could be sitting on an asset that's supposedly worth a lot of money on paper, but if you can't find anyone to sell it to, that value is effectively trapped.
This table puts it all side by side, head to head. You've got the office sector versus the residential sector. Sentiment, positive versus negative. Price trend, rising rents versus just stagnant high prices. But the real bottom line is that last row. The key factor for the office sector is strong rent growth. That's cash flow.
For the residential sector, it's low liquidity, that's trapped capital.
So let's boil this all down. What should you, as an investor, take away from this? First, the idea that a rising tide lifts all boats in Japanese real estate, yeah, that's over. You can't think of it as just one market anymore. Second, if you're looking for stable cash flow, the office sector is clearly where the potential is. And third, and this might be the most critical point, for the residential sector, it really looks like we've hit the price ceiling. Which means, if you're invested in housing, having a carefully planned exit strategy isn't just a good idea, it is absolutely essential.
So there you have it. This data is painting a clear picture of two completely different worlds, coexisting inside one real estate market. And that leaves us with a final critical question you have to ask yourself. As an investor, which one of those worlds are you truly prepared for? Because the strategy that works for one is almost guaranteed to fail in the other.